Hey there, and welcome to Real Investment News. I'm Mike O'Neill. The markets are climbing once again, getting closer to where they started at the beginning of the year, but is it going to be enough to keep the bulls running? Well, Lance Roberts is going out on a limb and saying no. In today's Technically Speaking, he lists the 10 reasons the bull market ended in 2018. And he says he believes the bull market actually ended in February. Now, I'm not going to go through all 10 points. That would make this video a little too long, but here are a few of the reasons why. Number one, the Fed continues to hike interest rates on the short end, pressuring the yield curve flatter. Now, we spoke about the yield curve a couple days ago. That's when the difference of the rates of the 10-year and 2-year treasuries, well, when they start evening out, it's essentially saying that investors are willing to lock up their funds for longer, even if their rates aren't as strong, because they expect uncertainty in the near future. So whenever the yield spread dips below zero, as it did here and here, well, a recession is close behind, and we're actually headed that way right now. Point number three, economic growth globally has begun to weaken as the boost to the U.S. economy from 3 hurricanes and 2 major wildfires has started to fade. When you look at the Citigroup Global Economic Surprise Index for major economies, you can see it actually dipped below the value of zero for the first time since last August. This is an indication that the global economic data is now generally coming short of what is forecast. Point number 7. Interest rates are starting to rise for variable rate debt, things like credit cards. Now, TransUnion is forecasting a 22.5% rise in credit card delinquency from 2013 through the end of this year. That's a startling number. Point number 8, price volatility is rising. Historically, significant increases in weekly point changes occurred when we are going in or coming out of meaningful market corrections. And the swings that we have seen this year, as you can see here, well, they are bigger than ever. Now, it should be noted that Lance does say that there is a chance he is wrong, and he hopes he is, because it is easier to manage money when the markets are rising. But when it comes to portfolio management, it's all about managing that risk, being ready if things start to go downhill. You can read much more in Lance's post on realinvestmentadvice.com. You can also take a closer look at all of these charts. In the meantime, thank you so very much for watching. Please remember to follow us on Facebook, YouTube, Twitter. Check out our past reports at realinvestmentnews.com. I'm Mike O'Neill. We'll see you again tomorrow morning.